Welcome back to Wall Street Podcast. Today we're doing a deep dive into the latest Wall Street Journal, the July 5th, 6th edition for 2025. We're aiming to cut through the noise, really focus on the essentials. We'll look at the shifting U.S. job market, the big new tax and spending bill from President Trump, and key global developments hitting the markets. Ready to jump in? Okay, let's kick off with the U.S. economy. June's job report. Headline number, 147,000 jobs added. Sounds, well, okay on the surface, but what's really going on underneath that?
Right. It's definitely a case where you need to look deeper. That 147,000 total hides some niftness. Private sector growth, it actually slowed quite a bit. Only 74,000 jobs added there, which is the lowest you've seen since October 2024. And get this, nearly half of all the new jobs came from the government sector. What's maybe more concerning is that over half of private industries actually cut jobs in June. That's pretty rare. Only happened a few times since the shock of April 2020, a real divergence.
Wow, okay. Government hiring masking private sector weakness. So what's putting the brakes on private hiring then? What are the main headwinds?
Well, it seems to be a mix of things coming together. You've got persistently high interest rates, right? Makes borrowing tougher. Then there are the federal crackdowns on immigration, impacting the labor pool. Add in the uncertainty around tariffs, businesses get hesitant. And don't forget the sort of looming question of AI and what that means for jobs down the line.
Yeah, economists are definitely flagging this, calling it a red flag even. They're expecting hiring might stay weak, maybe even contract through the rest of 2025. And that obviously has knock-on effects for consumer spending power.
Right. Makes sense. Okay, speaking of big impacts, let's shift gears to Washington. President Trump signed this huge tax and spending bill on the 4th of July. Sounds like a game changer for, well, everyone, taxpayers, businesses. What are the absolute must-know takeaways for you, our listener? Okay, the big headline is that it extends a lot of those 2017 tax cuts that were about to expire, so continuity there. But there are new things, too. Some specific deductions for individuals. Tipped workers can deduct up to $25,000. There's one for overtime pay up to $12,500. Also, a $10,000 reduction on interest for loans on U.S.-made cars. And a new $6,000 deduction specifically for seniors. And maybe the most watched item, the SALT deduction cap that's state and local taxes, it jumps up to $40,000. That's through 2029 for folks earning up to $500,000 a year. Big change for high-tax states.
That is a lot. So how's it paid for? And what about the big picture, the budget deficit, different sectors? I mean, if this adds trillions to the deficit as projected, how should sophisticated investors be thinking about this? Does this change long-term portfolio strategy?
Good question. The funding side involved some spending cuts, mainly to Medicaid and SNAP. Plus, there's a new 8% tax on endowments of the wealthiest universities. But yeah, even with those offsets, the projection is still a $3.4 trillion increase in the deficit by 2034. That's a huge number. And Wall Street analysts, they're definitely concerned. The worry is this level of government borrowing drives up interest rates further, which could crowd out private investment, make it more expensive for companies to borrow and expand. Now, there might be a small short-term GDP bump in 2026, maybe 0.2 to 0.5% from the tax cuts. But that massive deficit forecast suggests a longer-term battle for capital, government borrowing versus private sector needs. So for investors, yeah, it means thinking about how higher for longer rates might affect different types of assets, growth versus value, for example.
Okay, shifting focus beyond the U.S. now. What's happening globally that's moving the markets? Any key geopolitical flashpoints you need to keep an eye on?
Well, a potentially positive development in Gaza. Hamas reportedly accepted a 60-day ceasefire framework. The hope is this could lead to permanent peace talks. That's significant. Elsewhere, the situation in Ukraine remains critical. The U.S. has paused some weapons deliveries just as Russia seems to be intensifying its attacks. And relatedly, Russia's own economy is showing clear signs of strain under sanctions and war costs. On the trade front, President Trump is taking a hard line, threatening the EU with 70% tariffs if they don't agree to new trade deals. Very aggressive.
70% tariffs, wow. That's definitely aggressive. So how do all these things, the Gaza situation, Ukraine, these trade threats, military tensions, how do they feed into what investors care about, like commodity prices, supply chains, market volatility for the rest of 25?
They absolutely feed in. All these tensions create uncertainty, which markets dislike, right? Take the trade threats, that tariff talk. It's already causing shifts. We're seeing reports that TSMC, the big chip maker, is delaying a plant in Japan. Why? To focus more on expanding in the U.S. instead. That's a direct impact on global supply chain planning. And, U.S. actions regarding Ukraine, Russia's economic problems, those could easily ripple through energy markets, other commodities, and tensions near Korea with China's recent actions in the Yellow Sea add another layer of regional risk. So, yeah, putting it all together, it points towards potentially higher market volatility as these supply chains adjust and commodity flows react.
So it really underscores that navigating this landscape requires looking beyond just the domestic numbers. As you think through all this, remember the real deep dive is understanding these underlying forces, the shifts in capital, labor, global trade. The key question isn't just what happened, but maybe what does this mean for where things are headed next? That's our time to this deep dive. Thanks for joining us on Wall Street Podcast.